Recording in progress.
All right, good morning, everybody. I just seen an audio error, so if someone can give me an audio check, we'll be good to go and we can get started on this Monday. The bonds market is closed. Not quite sure that that's a bad thing. Asian market was on holiday last week. They're back. Thank you, Ben. I appreciate that. So it's a really light day, economic-wise. We've got some Fed speakers and some European Fed speakers, European Central Bank, and then here in the U.S. with Bernard. They've been talking off of the same same sheet, I guess. They're all singing the same tune. The kind of disparity or dichotomy between all those Fed speakers has been completely taken off the table. To me, it says a lot that they are almost rote, word for word, in what they're saying right now. They are not backing down. They're not giving up. They're not going to pivot. They're not going to pause. So there is this worry or fear that they won't have a choice, that they'll have to do something if we end up in a situation with, say, like what's going on over in Europe right now. They had to bail out the pension funds, basically. And if we get that kind of CDS over here, what they're going to have to do something. Or you would expect that they would. Now, that might not necessarily mean a pivot. Just like over in Europe, they're able to chew bubblegum and walk at the same time. Our Fed here, could possibly come up with alternative solutions, but we'll see. It looks like the Ukrainians took a little bit of the fight over to Russia. Kind of slightly amusing, I guess. Between now and the rate hike, we've got CPI and PPI. Those are going to be two of the hottest numbers that, or the two most pertinent numbers to pay attention to. And they really won't have an impact on what the Fed is going to do this cycle. But it does give us a glimpse on how far, how much the Fed has accomplished already. So right here, this is the November 2. We're currently sitting at 3%. There is an expectation that we're going to go to 3.75, that there'll be a 75 basis point rate hike. And there's nearly an 80% chance that we're going to get that 75 basis points. This one's not really being contested all that much. The December 14, if we were already at 3.75 and then we were to rate hike again another 75 points for December, that would put us at 4.25 or 425, say it however you like. So they're talking about two more 75 basis point rate hikes this year. And then that gets us into February, going from 4.25 to 4.5. Now that's a 25 basis point rate hike between December and February. So 275s, and then all of a sudden, suddenly, only a 25 basis point rate hike. And I bring this up because this number seems like a little bit of pie in the sky, rainbows, butterflies, and sunshine coming out of dark places, right? If they start pricing in 50 basis points for February, 75 basis points, we're going to see this market take another leg down, right? Because they're going to need to price in at least another 25, if not another 50 basis points to get this in line. So this would be the one that I'd really keep my eye on for more pain. It would be this one. If we're looking for uh, some kind of validation of a rally that we may see in this week, if we were to see a rally, it would be watching the December 14s to see if they're going to unwind 75 points off of this, maybe knock off about 25 points. That wouldn't be too far out of line. There's no expectation or reason to believe that they would unwind anything, but that's what I would look for. I'd look for this one, this big one here in the middle, to start to dissipate and see the one on the far left start to increase, right? Because they would be unwinding off of the 75 basis points and putting it on to the 50 basis points. Yeah. So there was multiple bubbles that needed to be popped, right? Or caps that needed to be kind of shaved off. And one of those is an earnings bubble. You know, there was like a wage bubble, there was an earnings bubble. There's all these different like little macro bubbles. And right now, everything seems focused on earnings. And as we come into the new earnings cycle, banks lead the way. And although Credit Suisse was in the news because because they put out a statement saying they were fine, and that spooked everybody. Because the last time they put out a statement like that saying everything was fine was like 07, 08 Lehman Brothers moment, and they weren't fine. They were lying out of the side of their neck. So this time they were trying to calm people, and they put out a statement like, hey, everything's fine. We're sitting really good. And that freaked everybody out, and they went digging into Credit Suisse's records. And what a self-inflicted wound. I was reading through some of the research published on it, and they really are fine. They're sitting, about as good as banks can sit at the moment. And they're an example of what good looks like, which is basically like trying to compare different piles of poo and figuring out like, is this one as bad as that one? But as far as banks are concerned, Credit Suisse isn't in that bad of a position financially compared to its peers. But they're all sitting in a really bad spot. And as it kicks off with earnings season in the banks, they usually set the tone. So something to keep your eye on is that right there. And there's talk about increasing the reserve that banks have to hold in case poo hits the fan. Right? It's like the dang fund. So there's talk about increasing that fund. And if they do, that's got to come from somewhere. Where's that money come from? And that's going to affect their earnings as well, or at least their statements of earnings. The assistance that the Bank of England came out and provided is going to be ending soon. And they're going to have to come up with something else. So that market supporting measure in its emergency gilt buying, that ends. And then what? They still need help, so they're going to have to figure something else out. Certainly something to be watching this week. Keep your eye on the FX markets. And it doesn't matter if you trade Forex or not, or if you even quite understand Forex or not. When you see a flash crash on any market, it stands out, right? So watch them, just kind of keep your eye on them occasionally through the day. You start to witness a flash crash in one of those, it is going to have rippling effects across the world and into anything that you're trading. And energy is the other one this week. Definitely keep your eye on energy. There's some trickiness afoot, right? All right, so we're looking at a yearly chart of the S&P, and got some weirder. Oh, yeah. The calculator. So I wrote a calculator a couple weeks ago to look at the expected move on the week and put it into a percentage basis, right? Instead of, every week we draw that box and we look at the box and say, okay, have we increased or decreased volatility this week? By how much? Right? But what's the percentage terms of how far the expected move is on the week? And right now, if you hand draw your expected move lines versus what this indicator gives, they're about 25 points off. Right? The hand-drawn lines are an additional 25 points farther out, which makes about 50 basis points from top to bottom. This is the size of the box of last week. This is the size of the box this week. You can see that we came up a little short, right? That's what she said. That's plus volatility. That's how much more volatility we have priced into the market this week compared to last week. Now, a little bit of that has to come from the fact that Barclays got caught manipulating the VIX, right? I'm sure by now most of you have heard that the VIX just isn't really acting right this year, and it hasn't been really useful. Well, if it's been heavily manipulated all year by Barclays and others, because they weren't the only ones, and now they can't manipulate it like they were because all eyes are on them, it may actually start responding the way that VIX is supposed to respond. And VIX is directly correlated and connected to expected move measurements, right? Because those are volatility measurements. What we're looking at with the lower indicator here is distance from moving average on a weekly time frame. And as you can see, we're moving closer to that 10-week, not necessarily because we're moving up to it, but because we're holding these lows and the 10-week is coming down to us. Either way, right, when we get closer to the center, it's basically like getting back into the middle of the basketball court. You have the capacity to make big moves in either direction because you're starting from the middle. When you're already sitting along the edges, there's really nowhere to go but one direction. So we're off of the lows, and we're just about where the midpoint would be for a normal reversal to begin. If we were already down at this point, we would be looking for a move up. The problem is we didn't get to this point where we are here from a move down. We got to this point from a move up. And that means that we can easily move back down again. Now that is a weekly. And this is the daily. It's a little more violent, right? It tends to change direction more frequently. We're not at the extreme lows. And I would still consider it having come down. Yes, it's up just a little bit, but it's from a move down. So we could see this as a pause before going lower, or as our reversal spot to make our way back up. And one thing that when it comes to technical analysis that you want to do is look back and find examples of your current situation in the past. We know that it's not going to do exactly what it did before, but it's that old phrase, how the markets rhyme, right? They may not be exact, but they'll be very similar to what happened before. So if we're looking for a move down and then a slight pause up, we'd want to look at where we've seen that before and not off of the major lows, right? So we had a little bit of a move like that here. And there, right? So you try to tie it in and find old examples of it. The main thing at this point is we're below the 10. We got there by moving very sharply, right? It took, what, 1 day to go from 1.25% above to 2% below. It's very likely going to cause a little bit of a whiplash or a shock. And then looking at the linear regression, right now we're in a position where we've got our lower low and we have a higher high, and that needs to be resolved. So right now we're looking, are we going to get a higher low here, or is this going to continue to come down and give us a lower low? So that's one thing that we need. And we're a long ways off from it, but we need an answer to that, to the high side. Are we going to get yet again another higher high? I find that unlikely. Or are we going to now set a lower high, which I find more likely? The reason I bring it up is because when it comes to taking a trade, it doesn't matter what your time frame is when it comes to these patterns or setups or whatever. This isn't a place to take a swing trade from, right? We're not at the bottoms, so we haven't broke out to go lower. We're not at the bottoms, so you can't look for a real bounce to go higher. And even if we start to actually go up this morning, you can't really have a lot of faith in it. We didn't move up off of the lows, off of anything. Right? It's kind of like the idea that if you're going to jump from something, you actually have to have your feet planted to get the push. So this isn't a good spot to try to go long. And it's not really a good spot to try to go short because you already missed all of that really fast. And it's very likely going to stop or at least pause at that 35.75 area. And if all of this lower area here is a zone, because we deal with pivot points not as one specific penny price, but as an area, then we may already be at a support area, and it's not a really good idea to take a short there. Now, I'm not talking about intraday trading, of course. You can get in and out and, be nimble 1 or 2 day trading very quickly, no problem. It's more the idea of trying to take a swing. And I'm evaluating the ES, but that all applies to the same way with, you could put the Qs in there, QQQ or SPY. It wouldn't really matter. All right, volume's a little light. Nothing extreme. If we were sitting at around 50 or 60, I'd be concerned, but sitting at 140, it's a little light, but nothing that really stands out, and that's the only thing we use this for, so we just turn it off at that point. We had an inside day breakout last night, and that is resolved at the moment. We're back inside the line. Might be a little bit easier if we just put that in a block. That gray area is outside of yesterday's price action, right, or below yesterday. So we had an inside day breakout. We got back out inside the box, went right back out of it again, and managed to get back in again. That did give us a higher low. And we have so far been getting higher highs, but it looks like it's running out of steam a little bit. Now, as we come into the open, all of that, very well is going to change up a little bit, I'm sure. We get more participants. The gap is closed, right? The gap between where we closed on Friday. Excuse me, the gap is not closed. Misspoke. That is where we closed on Friday. And the concern here is that we're going to close this gap and then we're going to dump. So really watch that 36.50. And remember, we can punch through it. It's not like we're going to touch it and then just fall. We can overshoot it a little bit. We can go through it. But that's the concern or the fear right now, is that we're going to get there, close that gap, and then really tumble. We have an ADR right now of $100. I'm just rounding up, 1 point. That's 2.7%. That's a normal average daily move. So seeing the S&P move 100 points today is nothing. Now, to keep things in context and how badly the volatility is being monitored or measured right now, the entire week's expected move is like 125 points. We've got an average daily range of 100 points. They say we can move 125 in a week, but we've been moving over 100 points a day. That's how far away or how off the volatility indicators are. Both pivot points are over our head. Right now we are in an MDP. That's a missed daily pivot. It actually is a strategy. It's not one that I built. And if you were to look it up on YouTube, you'd find a number of a number of pretty smart people that have provided strategy bones or guidelines on how to trade a missed daily pivot, MDP. At the very least, if you were to learn about the MDP, you could use it more in your analysis, right? But we also have the weekly pivot. The concept or the idea is that when we're below the weekly pivot, we're bearish. I don't think we needed to define this downward market as bearish just because of that, but it's one more check mark, right? It's not like you suddenly see that we're below the weekly and say, gosh, maybe it's a little bearish out there. Nah, I think we kind of got there on our own. But crossing back above it would imply that we're in a secondary or immediate uptrend in this primary downtrend. If we do get above, then the target will be yesterday's open, 37.15 or 37.11, the cog line, before the ADR full at 37.37, and then getting all the way up to the high of yesterday, 37.70. The previous week's high is 38.20. 38.11 is the cog line. We were down at the open last night more than 0.5%, and we went lower from there. But this morning we're almost half of that back, right? We kind of gained it back a little bit. Yeah, it's a little too far away. The previous week's high is sitting up there at 38.19, but it's nearly a 4.7% move. We could make a move like that in a day, but it would take such extraordinary price action that it's, well, it's unrealistic, right? We don't use that word or that phrase that says it can't do that. It's just really unlikely to do that. Making it to the high of yesterday would be 3.25 plus, and that is well within range, right? Because we got 2.7, we're talking about another 0.5%. So if we do happen to get through both of those daily, or the two pivot points, my target would be back to the open or back to the high. Let's say that, back to the high of yesterday, 37.70. And that's if we don't just crash and burn. So I've been talking about upward price action, but we still really should be considering the next leg lower. I know we all kind of get into that mindset where we say, well, it's already gone down a long ways. Surely it's due for a bounce now. And that's a dangerous mindset, right? It doesn't owe us a bounce. And price doesn't move in a straight line. So, of course, we're going to see some upward movement. But, that very likely is just a pullback before going lower. And so don't just assume or run out and start buying calls. I've seen people buying calls going into the close on Friday. They were YOLO calls, right? You only live once. But it just, with absolutely no reason to buy whatsoever, they were buying it just because of how far we had fallen Friday. And if it's only like 3 pennies or 5 pennies for the call, sure, I'm willing, I'm down, let's do that. But I'm not interested in spending, $300, $400, $500 on a call just because, well, we went a long ways in one direction. So let's go spend money on a call. If we do bounce, those calls, volatility is just going to get sucked right out of it, and that's going to take away a lot of your profit. You'll still make money, but not nearly as much as you could have or should have, because that call is going to get stripped of its volatility. Not to mention, if you buy it on Friday, you had 2 days of decay automatically right off the bat. YOLO! YOLO and Tina. If you want to look that one up too, Tina. That one had me confused when I first seen it. Too many acronyms out there. So one thing I want to kind of touch on, and I hit it at the beginning. That's too noisy. Is the FX markets and energy. For a long time this year, the dollar has been the thing that we've been watching. We keep our eye on it. We gauge everything off of it. When it's moving up, we expect our markets to go down, and vice versa. It's going down, we expect our markets to go up. We've kind of been really ignoring the VIX because it hasn't been that helpful. And we've been kind of gently keeping our eye on energy. Well, right now, the crisis in energy has the ability or the capacity to really take our market in different directions, to just really shake it up. But I had a lot of questions over the weekend about XLE energy and crude. And XLE is not crude. What you really want to be watching for this week is what's going on in crude prices. Now, you can use the futures market like CL, but you can also use ETFs, USO. And there's a Brent crude ETF that I just heard about, so I don't know very much about it yet. But you can go more than one way, right? If you don't have futures data, like say you're on Stock Charts or TrendSpider, they don't really have a good futures market. BNO, that's the other one. Brent Oil Crude ETF. So you can use USO or BNO. But what you don't want to use for looking at crude or oil is XLE. XLE is a basket of stocks. On Friday, for an example, the entire marketplace was down, right? Everything was just getting beat down on Friday, and that means companies. So Halliburton, Chevron, ConocoPhillips, those are companies. They're going to take a beat down when the market takes a beat down. And they don't reflect what's going on in, quote, crude or energy, oil. That may be what their industry or sub-industry or sector is, but they're still going to respond to what the rest of the marketplace is doing, right? The algos are going to trade into those just like they trade into anything else. So when you're looking at XLE, you're looking at a basket of stocks. The stock market, quote, quote, took a punch Friday. Those names went down. Crude didn't. And crude is a part of the problem or a part of the risk or the danger right now. There's benchmarks that we use, just like with VIX, right? We'll say VIX above 32.5 is bearish. You'll see the S&P take a new leg down. And VIX below 28 is bullish. You'll see the S&P heading back towards, say, 4,000. Putting in benchmarks like that is a really great way to kind of set some standards for bullish and bearish moves. We do the same thing with oil. Oil, not XLE. If oil gets too expensive, that's going to have a major impact on the markets. Still want to keep our eye on the dollar. The targets on the year are 120 and then consolidation before getting to 125. Now, we've been struggling around that 115 area, but if we do manage to break above it, then we're going to expect that next leg up. And instead of fading back to the 110 area to consolidate, we'll be fading back to the 115 area to consolidate. But first, we got to get above it. Now, I mentioned the FX market. Japan is now above that 145. We're going to have to see what they do about it, but the expectation is that they're going to defend. This is very likely to go parabolic if we continue to move up even just a little bit higher. And bonds are closed today, and I don't quite know how much that's going to stress things because, you know, they still trade just like the S&P or the NASDAQ futures. I mean, we're closed, but they're still trading, right? Because the market opens at 9:30, but the futures were open all night long. So, sure, bonds are closed, but that doesn't mean that they're not being traded. They're just not going to be traded with size. There's already a liquidity issue. That adds to the liquidity problem. And these FX markets can be traded as USO or as ETFs. So FXI, FXC, You can use, like EEM, things like that. So you can trade these without having a Forex account. Watch the US dollar Japan. If we do start to break out above that 154, 145.5, there is very likely to be a direct impact on the dollar, which is then very likely going to have a direct impact on the S&P and the Nasdaq, right? So whatever happens in the Japan Forex market is very, very likely to ripple drastically and fast across the S&P and the Nasdaq. That's why it's worth watching closely. Absolutely, there is no alternative. Tina. The acronyms that people come up with are funny. And maybe a little sad, but funny. At least they're not playing Dungeons and Dragons with their S&P and Nasdaq options. That was a spoof off of Twitter that I seen the other day. That was pretty funny too. All right. Looking at the S&P 30-minute chart, 10 days. We got the volume profile in green and TPO, which is time, in blue. You can see that we're at the point of control, a significant level of resistance over our head. And this is a very beautiful looking flag pattern. When I was studying flags, I was looking for warning signs that a flag was failing. And what I ended up getting is an entire strategy based on a flag failing to continue in its pattern, right? So like back here, we had this flag, and a flag is supposed to be a pause before prices continue to go lower. If it, quote, fails, then instead of going lower, it actually reverses course and goes back the other direction. And it ends up forming this really nice cup. And then you get the handle on the cup and the continuation. Right? So a failed flag play is what we have going on right now. It's a pretty sexy one, all things considered. I've seen some really nasty looking flags, and this one, it looks pretty good. But if we zoom into it a little bit, you can see it ties in with that channel. The way I like to do this is just use the fib. It gives you that 786 as the channel top. Well, that 786 is really close to Friday's close. So it's that gap fill. And if we're going to see a failed flag here, it would be that we get through the gap, we fill it, we close it on the other side, maybe we get a little bit of a Busby, and then a continuation. Back up to the top, where we very likely will get a little bit of a handle inside the cup, and then on the outside of the cup if we happen to get above 37.70, just like we did back here. Right, there's the cup. We have a little mini handle. Then we got out of it. We had another handle. Both of those look a little small in comparison to how big they should have been, but so watch this not just as a channel or this consolidation package back here, but as a bigger pattern, that failed flag play. And it should give you benchmarks all the way back up, like 50%, 75%. And then, of course, there's look left logic, and we can start running fibs on the other side of it on the way back up. There's still a significant amount of resistance from old volume, and we don't see a shallow area until we get up above 3720 area. So it should, or it's very likely going to be just a lot of fight. Kind of like what we had back here, all of that kind of price action. A lot of fighting. All right, 5-day, 5-minute volume profile. We have no untouched points of control to bring forward unless there's some from down here. And there's not. So no untouched points of control to bring forward. Looking at yesterday's volume, we've got a pretty good sized cluster starting at 3670, maybe 3675, all the way up to 3695. So it's nice and shallow if we can get through this Globex high. We get into a shallow area. We could move through that from 3650 to 3675. We could move it through it pretty good, pretty easy, all things considered. Not a lot of volume resistance there. All right, here's the VIX market. This is supposed to be going from the lower left to the upper right in a gentle curve, much like that. In yellow, that's what contango would look like. That's normalcy. When it goes the other way around, that's backwardation. This affects so much stuff. A lot of options, definitely. If you're looking at the VIX, that's 1 month out. So that would be like the 1st of November. That would be this first data point. But using the VIX, you can also look at the 3-month, the 6-month. Just type in the words VIX and then add the number behind it. So 3 would be 3M. 6M, 1Y. That's just for anybody who doesn't have futures. Come into the futures. Look at all of them. Don't look at that 9-day. It's too close, right? You want something a little farther out. 30 days is a good starting point. The Novembers. 31.44. And then you get into December. 31.52. And you just keep doing that, right? Go farther and farther out. So this is the VIX. We are gapped up to 32.85. If you do buy calls this morning, say we start to rally, this thing is going to gap close first, and it's going to just strip those calls away. All right, so at the very least, even if you're trying to do like a day trade, you may be better served using a call, say an in-out spread, a call debit spread. You buy the option in the money, sell the option out of the money, that gives you a spread. It won't make as much money as a naked option. You know, if the S&P was to travel, I don't know, 5% today, the call spread wouldn't make as much. But what's the likelihood that we're actually going to get a 5% move today? Otherwise, the amount of money that you can make from the spread is likely to be comparable to the money you're going to make from the naked option, except that that naked option is going to get vol crushed. Now, if you're selling puts, that volatility crush is very likely going to help your puts get into its moneyness very fast. This is one that kind of gets my attention. This is the Skew Index. Just to kind of get rid of all the kind of nerdiness that goes to this, kind of put it into simplistic terms. This is measuring the expectation that the market can make a 2 standard deviation move, or the likelihood that it could make a 2 standard deviation move. We've seen the market making 1 and 2 standard deviation moves in a single day, plus 2, right? So we know that it can. Why is this thing reading so low? Now, I don't want to take credit for this phrase because it's not my phrase, but I really love the way that it kind of puts everything into perspective. This is a gauge or an indicator that's asking people through how they trade, what's the likelihood that we're going to get an outsized move? And the likelihood is very low. Tie that into the fear or the likelihood that something bad is going to happen when you're watching a scary movie. The first time you see it, it might shock you, and you know it's the shock and awe, and like, oh wow, everybody screams, popcorn's flying. The second, the third, the fourth time you see that movie, you're laughing, throwing popcorn at the screen, you're talking poo, you're not scared. You have no expectations that anything unusual is going to happen because you've already seen this before. Again, that's not my analogy, but I love it because it really fits. This skew reading is so low because even though the S&P and the NASDAQ and everything is dragging along these June lows, we've been here before. It held, it was stable, we came back up through it. There's no real fear or angst at this point. This isn't capitulation by any stretch of the imagination. So look for that skew to start picking up. It'll be an indication that people are starting to get worried again, and that the expectation that we make a big move is going to come back on the table. We had flash crash warnings on Friday. And yet we still closed higher on the week. Right? So as bad as Friday was, or last week was, it was still a positive week. So just something to kind of keep in mind. we'll take a look at stock, but I mean, we got to kind of have the expectation that there might not be much moving around yet. So we're looking at how many names in the S&P are down 0.5%. 14. All right, well, let's flip that over and say how many are up 0.5%. 5. So a real sideways market this morning. And until we get some economic data later in the week, we may have this expectation of a market just kind of holding its levels. Sure, it could, set new Globex highs or new intraday highs and lows, but we're not going to be looking for a complete and absolute shift in market structure until after CPI and PPI. We flip it over the same way for the NASDAQ. How many names are up 0.5%? 3. And then down 0.5%? 25. So 25% of the NASDAQ is down this morning 0.5%. So the reason I took the opportunity to cover other things like the Skew, the VIX, is there really isn't a whole lot on the stock side of things that would give us an indication of what we would want to focus on this morning. Got a little bit of a squeeze in oil services. It's OIH. And gold came out of a squeeze on the short side using GDX. Even sizzle is off. There's just nothing really kicking off yet this morning. I call this a market looking for an excuse, right? It's looking for a reason. I don't expect that we're going to have a significant change in market structure until PPI and CPI. But keep it in mind that those data points this week isn't going to change the Fed's trajectory. It's only going to change traders. And the institution, JP Morgan, Goldman Sachs, Wells Fargo, those trading desks, those institutions, their time horizon is a lot farther out than what this one CPI print or PPI print is going to give us. Banks do kick off. I didn't think it was this close. I thought it was Monday, but it could be Friday. So that's the 14th. That's 4 days away. That's Friday. That's JP Morgan. Bank of America on the 17th. Wells Fargo on the 14th. So yeah, this Friday, that's the start of all of it. Just to review this real quick, the XLF is it's a handy ETF to use to evaluate what's going on in the financial markets, but the XLF has a lot of extraneous junk in it, right? Because if you say financials, quote, that can be insurance companies, trading desks, regional banks. I mean, it's got everything in it. I stripped the XLF down in my charting grid here to these two groups, JP Morgan, Bank of America, and Wells Fargo. I lumped them together in one group. Citi, Goldman, and Morgan, I lump into another group. These three on the bottom very generally act as a group. They usually have the same charts, they behave the same way, and these three across the top seem to do the same. They all make up the package of XLF, but that's generally how I keep an eye on them, right? And if I want to trade, say, Wells Fargo on the idea that JP Morgan already made it to the bottom, Bank of America very nearly at the bottom, Wells Fargo hasn't yet made that move pattern-wise, and that if it's going to continue to match its peers, then it's very likely going to make that move. That's just an example of one trade, right? Morgan Stanley already made the move, but Goldman has not yet made the move. Citi is nearly halfway through its move. It's one way to approach it. Obviously, it doesn't always play out, right? But the same thing goes for a long entry. If I wanted to go long in JP Morgan, or if I wanted to go long in Bank of America, I would be really concerned about Wells Fargo first, right? I wouldn't want to necessarily go long here until I knew for sure that this wasn't going to continue to go down to try to finish that move. So I'd want to make sure that this was also going up to try to get along here and here. So, I mean, there's a lot of ways to kind of approach it, but this is just finance, right? And one thing I like about trading finance is I like to avoid earnings. If these kick off earnings season, everything else that I can't trade because it has earnings, I can avoid, and I can come in and trade finance because, well, finance already had its earnings. So it's usually the first thing I end up getting trades on when we get into a new earnings cycle, because as soon as it's got earnings reported, we can trade the outcome. The other one for finance is KRE. But I don't break it down the same way. Yeah, I missed it. There it is. And the names are not as liquid, right? So you might be better off just using this for your evaluation purposes and not trading the names in it. On my day-to-day activities, I watch KRE way more than I watch the XLF. But the names in here, liquidity-wise, I'd rather stick with the XLF. So I got for you guys, be careful, be safe, have a good week. Watch those Forex markets.